Well, hello traders everywhere. This is Adam Hewison coming to you from the digital studios of Market Club. It's the day after Janet Yellen finally decided to raise interest rates here in the United States by 0.25%. Janet, I think it's a little too late, and you have no clue what you're doing, in my humble opinion. This should have been done months and months and months ago. The market reaction yesterday, of course, was very positive. We rallied, but look at today's action. We're down. And look at what we've been saying all week, and all month for that matter, that December is a very volatile month at the best of times. And if you look at the action in December, you can see if we just start, let's say right here, November 30th, that's the action. We haven't gone anywhere, and in fact we're down for the month, but we haven't gone anywhere, and it's been very, very volatile. You've had moves that are, I think, really kind of unprecedented even for December. You've had, I mean, look at the moves here. You're down here, up here, down, up, and we may be going down again. In fact, if you look at our weekly trade triangle, which has been telling you to be out of the market for a while now, that seems to be a very, very good analysis of what's going on. Don't even mess with this market at the time being, at least in the major indices. Let's go on to our next market. Pretty much the same thing with the S&P 500. We've got a weekly trade triangle staying sidelines. It's a trading range. If you want to trade the markets, you don't want to do it on daily charts. You want to do it maybe on hourly charts, which we have right here. You can see if you go to hourly 60-minute charts. Here are the 60-minute charts. This is just 5 days. You can see how the market moves. If you're going to trade, that's the way to do it, not on daily charts, but I don't recommend that for most traders. Moving on to the NASDAQ, you can see you have a complete outside day in the NASDAQ. It's not a good sign. If we close down here and we close lower on Friday, that to me puts in another top. It also confirms our weekly trade triangle, and also if you look right here, we're actually below the RSI, which means the trend is really beginning to weaken, not strengthen. So pay close attention to that. You should be, again, out of the market. Major trend still positive, minor trend negative. Gold is not acting well. All of our trade triangles are in the red column, and this is the last sort of bastion of support right here. Let's see if that holds up. A little bit different in the vectors. We have a weekly still green, but nonetheless it's going to reflect pretty much what stocks and also what gold does. We're also below the 50 line, which is not necessarily a good sign, with a minus 75. Gold shares that the GLD ETF hit a new low here, but it's coming back. Nonetheless, all of our red triangles are in place, and the trend is down for this particular ETF. Here's the euro. We've had a pullback since the highs we saw, and we were looking for this market to go up. I still think the trend is going to be, certainly the intermediate trend is positive. The very short-term trend, which you should be looking at, is negative, and that turned negative at 109.28. So meaning you should be out of the market right now in the euro. We're back down to a support line at 50 on the RSI. Crude oil, this does, obviously the trend continues down here. We have like a 30 print we're going to be looking at. The 28 to 30 level is a measurement. I'll show you how we came to that measurement real quickly. If you just look at where we were here and where we were here, so you've gone from 40 to 50, a little bit over 50. If you just push that down, you could see you're looking at a print of, I think, $28 to $30 a barrel. That's where we're looking for. So let's see how that plays out, but nonetheless the trend is down, and that's the key thing to remember. Just want to show you Apple. And how badly this is acting. We've been talking about this for some time now. The weekly has been down. We said to be out of Apple. That's from 112.27. It's 109.55 currently trading. But we've been saying for some time that Apple has not been acting correctly for for all the hype, all the great products they make. The news came out that they're not selling as many. They don't expect to sell as many iPhones as they did before. And let's face it, guys, I think the market's saturated with smartphones. I mean, everybody has one. And what's going to induce them to go out and buy another phone? That's why Apple introduced this, a new phone every year. Just keep paying us, paying us, paying us. It's all about recurring revenue for any company, and that's particularly true with Apple. Facebook, you can see we popped up today, but again, we've got the red trade triangle saying you should be out of this market right now. And sometimes these red trade triangles come in, and the market can rally, but it just means there's a conflict between the major trend, which is positive, and the intermediate trend, which is negative. So be on the sidelines on Facebook. Under Armour, They should be having a spectacular year. They're not. You can see we're down dramatically from the highs in October, around the 105 level. We're down 81. That's a huge, huge move in Under Armour. And the question is, what's causing that? This will be a new close for the week in quite some time in this particular stock. And if we go out for the year to date, you can see, yes, it's done well for the year, but we could be down here the way it's going right now. We could be down to 70 or 65 by the end of the year. I mean, I think there's going to be a lot of retailers go out of business after Christmas. I think they're just hanging on by their fingernails. I think the mall traffic has been very light. Sales are being very light. Everything's being done online, and that's not good for the malls. It's not good for retailers, and it's also not good for mall owners, real estate. Walt Disney, we've talked about Walt Disney. The trend is down. That's not a good sign for Walt Disney. And you can see potential twin peak here. This is going to be a key area around the 92 level. We just got back to the 50 line. That's resistance. We're going to look for this market to come back down, in our opinion. Amazon, this is the real juggernaut. We're looking at this market. This trend is up. The major trend is up, but the minor trend, intermediate trend, is down. Not a good sign. And Amazon's doing extremely well. So let's see how that plays out. But nonetheless, you should be on the sidelines in this stock as well. Last stock, Netflix. Again, conflict, major up, intermediate down, sidelines. Hey, I'm Adam Hewson. It's been one heck of a week with the interest rate hike, the volatility, and everything else that's going on. So keep your powder dry. Keep watching the 12 trading tips that we have this month and all the way through to the holidays, and you'll find you'll be a better trader in 2016. Have a great trading day, everyone.